profit is necessary for the survival of the business, but what exactly are you going to do with the profit? This section of your feasibility study aims to set an adequate profit target and then determine the level of sales you'll need to achieve that. If you want to upgrade your plant and equipment or expand the business, where will the money come from? You could borrow it, lease the equipment, or as many small businesses do, reinvest the profits. From the profit you make in running your business, you'll want to take out money to live on. But there are other things that must be deducted from the profit before you can have your slice. If the business is profitable, then income tax will be payable, regardless of what you do with the profit. For example, even if you're reinvesting it. If you've established the business using borrowed funds, then you'll need to repay the lender in accordance with your contract. The repayment of business loans is made up of two components: the principal, which is repaid from profit, and the interest cost, which is an expense. Once you've dealt with these commitments, you should then put aside funds for future replacement of worn equipment, future expansion of your business, cover for bad debts, updating of equipment to keep pace with current technology, and an allowance for inflation. Finally, you can consider some reward for your own time and effort in the business, return for the funds you've invested, and you should also make some allowance for the risk of investment. Consider this: you're investing your time and say $20,000 into a venture. Is a 15% return adequate for your time, investment and risk, or would you rather leave your money in a bank and earn 6%, since you wouldn't have to work for it and your money is relatively safe? Target net profit is the sum of the money your business needs to generate over and above operating expenses and the cost of goods sold. Now, go to your workbook and complete the target net profit table. In Module 3, you calculated your total estimated operating expenses or overheads. Those amounts you have to pay just to open the doors. Usually, it will cost you something in stock or materials to create the goods or services you sell. And now you've decided on your target net profit, that will give you an indication of the amount of tax you'll have to pay. So what turnover or sales do you need to generate to pay your bills, the taxman and yourself? It's easy. Just total all the amounts you've worked out so far. Target net profit plus tax on profit plus operating expenses plus cost of goods sold equals desired turnover.